The management of Uplex is joining us. We're trying to understand from them, will a falling crude cap margin contraction for their business? Rajesh Bhatia, who's Group President, Finance and Accounts, and CFO Uplex, joins in for a quick chat. Rajesh, good to have you on the show. Have you been able to, have you seen a rapid drop in prices of your crude-derived products, materials, essentially? And what does that do for your margins?
Yeah, there has been a drop in the prices, followed by the drop in the raw material prices, and I think the margins will be largely maintained this quarter as well as the next quarter. So the prices have come down from say 135 rupees to about 115 rupees now, so 20 rupees, and we also seeing a raw material drop from mid October levels to now about the same number. So it's commensurate.
Percentage of your raw material costs comes from crude?
I think about 60% of our cost is the raw material cost. So that is basically all crude linked.
What about inventory losses? Would you face that this quarter, given the pace with which crude has fallen, there may be some high-priced RM inventory with you?
I think not much. These things keep on getting adjusted because we not holding much finished inventory or the raw material inventory. I think they'll be minimal. On the finished goods sides, normally we have not more than 3 days inventory. So that's not much on the film side.
Okay. Rajesh, your EBITDA margins had contracted in the last quarter. Will that contraction be stemmed from here on, or do you think that there would be continued pressure on your margins going forward as well?
So I think I've been saying that the EBITDA margins have to be looked in the context of the raw material prices. A higher raw material prices for me does not necessarily mean that my EBITDA margins also change, because largely the industry is working on a sort of a fixed contribution per ton, rupees or dollars and all that, and when the raw material prices goes up or go down, so the EBITDA margins will look different in different contexts. When I'm selling at 135 rupees the films, and I make say 35 rupees, and when I sell at 115 rupees, I still make 35 rupees. So I think the margins will look differently. But I can tell you that the overall margins, rupees per ton or dollar per ton, were much better in H1. So while as a percentage of the revenue, you may see that they may be a bit off-colored, but in reality, it's not so, as we give a lot of impetus on the per ton, rupees per ton or dollar per ton margins, which are much higher in H1 of FY19 as compared to the last year. So overall, we made more money in H1. And that's what matters.
Okay. Tell me, how is it that you're pricing your contracts, and is there a direct pass-through, or there are frequent negotiations that work in?
So normally in the packaging industry, we have spot, and then we have a 1 month or a 3 month contract pricing. So I would say about 40% spot. So that prices are determined on a month-to-month basis, and rest are 1 month to 3 month, largely in the 3 month category, where the previous quarter crude pricing and indices work in terms of the next month's prices, next quarter prices. So when the crude prices this quarter have come down, while the applicable prices will be for the last quarter. So we stand to gain. Last couple of quarters, we've seen that the raw material prices have been going up, and that works to our disadvantage under recovery in our packaging business. The films business is absolutely steady, and there is now a weekly pricing from the refiners and all that, and the selling prices are adjusted instantly according to that.
Right. Last quarter then, you saw very strong 20% plus kind of top line growth. Will that be sustainable?
So I think with the crude prices having come down, those numbers we will have to replace with the so last quarter, if you see, while we had a 11.5% volume growth, but the value growth was 26%. So that means that, apart from the volume led growth, there was a differential, which was basically on account of the raw material price growth. Now, with the crude having come down, I think there'll be, we will not have kind of a volume growth. I think as a business, we are happy that, if we are like, FY 17-18, FY 19 over 17-18, we had, about 10%, 11.7% growth in the packaging volumes. This year, H1, we have 11.4% packaging volumes growth. In the films, we had last year about 7.9% growth, while in the H1, we had a 13% growth. So we are happy that, if there is a stability of the prices, so there is no undue fluctuations in the raw material, in the working capital requirements, margins are also much better. And then, you're not on the prices going up or the prices going down. There are no stock losses that or the gains that come your way. Static earnings, double-digit volume growth is what we looking at our industry when we go into FY20.
Okay, and lastly, you've launched a very innovative and strong range of products as well. What's been the response, and what kind of margins are you enjoying for these specific products?
So I think one of the important product that we've breakthrough we had is that we could get a US patent for a particular film for the use in the pharma industry per se, because if you see the pharma packaging today, that the blister pack, they were using PVC and nylon, which was actually not conducive, because they emit some poisonous gases, and they are not good. NGT in fact had already banned them, but in the absence of any alternate alternatives, people were still using that. But I think we've got a breakthrough in this. It's not going to impact immediately. I think it's a good innovation. We've got it patented for 20 years. Overall flavor is that worldwide this pharma blister packaging is about a $20 billion market, and with all the agencies coming down heavily on PVC and nylon use in the pharma packaging, I think if we look at a 3 to 5 year horizon, this can really be a game changer for Uplex. As of now, it's very initial stages. So we are, sort of working with our customers. As we go forward for this, we'll also have to, look at investments, because, if you're looking at even let's say a 2% market share, that itself is, sort of a huge business for us. But I think the real impact of that will be felt over the next 3 years period.
Okay, good to hear that, and thanks so much for taking the time out and joining in today, Rajesh. Good to speak with you.
Thank you.